Hello everyone. Today I decided to record a different video on market psychology. And the reason I decided to do that is because some members in my community, and rightly so, have been a little concerned when it comes to deploying some of the hard-earned money into the market, right? And especially if you are someone that comes from a different background and if you don't have any investing experience, I understand how difficult it is to detach your emotions from any business fundamentals or any sound investment decisions, right? Which is exactly what we want to do. And so I just decided to record this video, and I'm going to show you a few things that will hopefully bring home my claim here. Okay, so first things first. Another important part of this is that valuations are really very high across the board. I'm talking about, again, I'm talking about specifically emphasizing the US stock market, which is probably the most common, the most followed market in the world, of course, where there is the most liquidity and also the best companies in the world. And I want to show you a few things right here first before delving deeper into the emotional aspect of investing. You can see that from a based on the Shiller P ratio, the S&P, for example, is almost at all-time highs, trading at a PE of 38.80. I mean, look, you can make the case that the PE has been going straight up ever since 2008, which is true. I'm not going to deny that. But it's also true that not great things happen once it gets to an egregious stage. And I believe we are currently at that point. Please bear in mind that you can see that the average sits at the medium is about 16, as you can see. So we are way ahead of that. We are trading well above that level, and this is a sign of caution, if you ask me. Okay, so very high valuations from based on this metric. And also another important one that I like to track is the Buffett Indicator. And the Buffett Indicator, for those of you guys who don't know, essentially is the total value of all publicly traded stocks divided by GDP, divided by the country's GDP. And you can see that we are trading at all-time highs. Look where we were back during the 2000 bubble and back in the 2008 bubble. Okay, so this is very concerning to me. And these two indicators really are really flashing red. And so because of that, I believe volatility is going to be guaranteed over the next months of years, okay? Especially with Trump in power. In the politics aside, we know that Trump can be quite unpredictable. We never know what's going to happen. And so with volatility at this high in the stocks overall priced for perfection, it makes sense for us to take a more cautious approach. And I just created this Word document that you can see, and I will be sharing this after this recording. And you can see exactly as I saying that the real threat to your wealth is not the market but yourself. And so this is important. And the point that I want to reinforce here is that according to what Charlie Munger said, and throughout this document, you will see quotes from some of the most successful investors of all time, and they all stress out how important it is to leave emotions out of the equation at the time of making an investment. Okay? And so a lot of people with high IQs are terrible investors because they've got terrible temperaments. You need to raw irrational emotion under control. That's Charlie Munger. And Terry Smith, also known as the British Warren Buffett, the greatest threat you face to your investment performance is from you. Okay? So why is the emotional aspect so important? And why does it affect our investment decisions? Well, because we are human beings, okay? And human beings are emotional beings, okay? So it stands to reason that throughout our lifetime, we're going to make many decisions based on those same emotions. However, from an investment standpoint, you can see how much this can hurt you. So this is famously, if you are into investing, then you probably saw this before. This is typically what happens during market cycle. So you can see that we have big peaks of euphoria where stocks and asset prices trade at all-time highs. Then there is a big crash, and then there is a rebound, and that's what's called complacency, where investors are drawn to believe that the new all-time highs will soon be hit, and there is no reason to panic. But then soon enough, there is another big collapse, and then we have anxiety, denial, panic, and then we have anger, and after a while we have depression, right? And so this is, in fact, if you look at many charts, for example, Amazon, and not just Amazon, but there are many different charts, you will see that they all mirror this one right here. Most of them do. And especially if you go back to 2020, right before the pandemic, you can see that tech stocks are, they do really mirror this one right here, especially the unprofitable names, like, for example, unprofitable names like Zoom at the time. They reached all-time highs with the peak euphoria. Everybody believed because these were the most loved tech companies at the time. Okay, they were the pandemic favorites. They essentially drove these the stocks prices to all-time highs. But then what happens is, after the pandemic faded, right, those concerns faded away, then the market suddenly crashed once fundamentals played the stronger hand. And so you can see this is the investing psychology works across different asset classes. No matter we are talking about cryptos, stocks, it's always the same thing, because it's emotions that drive these asset prices over the short, medium term. Okay. And so your risk is higher when we are at the stage euphoria. And that makes sense, because even a company can be phenomenal. For example, let's talk about companies in specific. A company can be great, but if they report earnings and if they miss those earnings, even if it's just ever so slightly, what happens is that alone will be enough to trigger a huge sell-off, because the stock price is already priced for perfection, right? So there's no margin of safety built into the price. And the lowest risk levels that you can face are when something is near the depression levels, because a lot of the selling has already faded, right? And a lot of the weaker hands, as it's commonly denominated in this space, already left the market. And so risk comes down with lower prices and not the other way around. Does that make sense? I do hope so. And please don't forget to leave a comment if you find the content in this video helpful. All right. So I of course, because you already know that we follow the like a tortoise approach to investing. So we will never buy anything at the highs. We want to buy great companies when they are trading, when there is an event that causes the stock price to come back down, and that there is a lot of uncertainty, there is anger. Many analysts and investors are depressive, right? They don't believe on the outlook for the company. They become too pessimist. In the background, fundamentals continue to improve, and that's when you can exploit the gap between value and price, which I love doing. All right. So let's go back to our Word document. And by the way, before we do that, this is another quote from Warren Buffett. The stock market is advised to transfer wealth from the impatient to the patient, right? It will always be the same thing. And that's part of the reason why the average investor fails to even match the benchmark, the S&P 500 over the last 20 years. It's because most people don't know what they're doing, and most of them react emotionally, exactly because they lack a core, they lack a strong framework to base their decisions upon. Going back to the Word document, this is the emotional side of investing. And so fear, greed, and hesitation. We all investors go through it. That was certainly my case when upon starting my investing journey, and that same reason caused me to lose a lot of money as a trader, right? Because I was basing my decisions at the time on technical analysis. And that's fine. I mean, look, you can make a lot of money doing technical analysis, but even that requires a robust framework, which I lacked at the time. And so, fundamental analysis is not just looking at the charts and making a decision. No, there is a strategy, there is a process that you have to implement, and then there is a lot of consistency that is required over time, discipline. And if you lack those, you're going to lose money. All right. So examples of emotions in action: panic selling in March 2020 COVID crash. We've discussed that already. And chasing AI stocks in 2023 when prices were sky high. And you can see, for example, you're looking at the chart of an S&P, of the S&P, you can see that right after the COVID pandemic, when a lot of people were selling the markets, then the Federal Reserve intervened, right? And that pushed prices back up. And so look, going back to 1936, you can see that there have been many reasons for you to, many reasons to sell. From World War One to World War Two to pandemics to Cuban missile crisis to global financial meltdowns. So there have been many different reasons to sell, but you can see that over time stocks always go up. And so if you are an optimist by nature, and if you believe the world is going to be in better position over the next 30, 40 years, then stocks are the place to be. Okay. And I'm definitely in that camp. And so why emotion sabotage returns, herd mentality, loss aversion, and overconfidence lead to poor timing. Okay. Herd mentality. So most people will follow the herd. And that's a very, very dangerous move. So we like to be contrarians. That means buying when people are selling and selling when people are buying. In the words of Warren Buffett himself, we are greedy when others are fearful and fearful when others are greedy, right? And if you do that consistently, and if you combine that with the robust framework, then I think you're going to make a lot of money. All right, and we will talk about that later on. Now let's talk about practical tools to manage your emotions, because I think these are really, really important. And the number one is tortoise mindset. And when I say tortoise mindset, what am I talking about? I'm talking about a value investing mindset, where you believe that slow and steady compounding will definitely trounce any other returns achieved by other investing approaches. Okay, we are not here to chase quick wins. We are here to build a solid portfolio that is going to compound over time, and that's going to allow us to retire very rich. So also, we base every decision that we make on fundamentals. Okay, right? We don't care about short to medium term sentiment. We don't care about headlines in what's on the news. We care about one thing: fundamentals. Because over time, and I will show you one more chart right here, you can see that price will always follow the evolution of the company's earnings. So if earnings grow, the share price of any asset class, again, we are talking about companies, the share price of those companies will follow along. Okay, good. And yeah, so that's one thing. So it comes down to the strategy that you implement, and the strategy will allow you to become more rational and be less emotional about your investments. Also remember that the tortoise approach strongly recommends studying your companies very well. And why do you think that's important? Because let's think about this for a second. If you know what you own, the odds are that if the company continues to go down, right, if there is a big sell-off, chances are that you will feel comfortable buying more shares in that company and thus increasing your stake. Okay, most people will sell most people will sell at the lows because they don't understand what they own. And if you don't understand what you own, you're going to become far more emotional at the lows, precisely when you should be greedy. All right. And so let's go back. Decision journal. You can write why you are buying into that company, right? And then later compare reality versus thesis. What went wrong? What went well? I find this can be a nice way to keep your emotions in check as well. And then, of course, goal anchoring is important. Most people chase quick gains. However, if you zoom out, you can if you zoom out, what happens is you will not pay attention to daily price swings, and you will anchor your decisions to a long-term investment plan. I'm talking about 10, 20, 30 years. That's what this strategy, right, the tortoise mindset is all about. Okay. And then something that you can do, and I did this before, and it helped me a lot. And in fact, and we will talk about this later on. But one of the things that I want you to do is you can write down 3 investing fears. What are the main fears that you are facing at the moment when putting your money to work? Okay, and then you try to reframe each as a long-term opportunity. So, for example, if you have the fear of volatility can lead to stocks on sale, that fear of missing out, right? Patience leads to better entry points. The fear of volatility is not, and the fear of missing out are something that you shouldn't follow, okay? Because in fact, you should take a contrarian view, and you should see volatility as your friend, and you should stay away from FOMO, fear of missing out, because and this is something that you can practice. All right. So when everybody's piling into NVIDIA because it's making new all-time highs, right? It keeps making new all-time highs every week. It's going to change the world in 10, 20 years. That's already beside the point, where so much of that growth in optimism is already built into the stock price. Okay. Don't FOMO. That's fine. The market will not go away. There will always be another market over the next month, over the next many years. And so just because you miss a company today, it doesn't mean that company is not going to be available at a much more attractive price in the next month or so. So be patient, right? Good. And so the second part is wonderful companies, framework, and emotions. Once again, if you follow the strategy that we highlight, meaning mode management and buying stuff when they have a margin of safety built, you are on your way to minimizing your emotion, to minimizing your you are well on your way to making less decisions based on your emotions, right? And this will definitely help you achieve much better returns down the line. So, for example, investors piling into Tesla in 2021 purely out of hype without valuation discipline were punished. If you look at the 2021 chart, you can see that the ensuing months were terrible for investors because it really crashed 70 or 80%. And if you didn't know what you were holding, chances are that you would have sold at the exact lows. Now, probably one of the most important strategies that I want to discuss here, the inversion and rebuttal framework. And this ties into what we discussed briefly above. Why is this so important? This is one of Charlie Munger's principles, right? Invert. Whenever you want to find a solution to a difficult problem, you should invert. Always invert. What does that mean? Once you determine which company you want to invest in, so you've gone through the 4M analysis, meaning mode management and margin of safety, and the company checks all those boxes, then what you can do is you should ask yourself reasons not to buy that company, right? And now you are inverting the problem. You are identifying, for example, 3 reasons not to invest. what can go wrong with that investment, right? So, for example, margins shrink due to new competitors, regulation caps profits, management dilutes shareholders. So you are trying to find plausible reasons, and some of them do exist, okay, because there is always a risk with any investment. But are you okay with those worst case scenarios? Okay, and then you should, and that's what when you should rebut each reason with evidence. So, for example, in terms of new competition coming into the market, one of yeah, you could say company still has scale advantages. Okay, regulatory risk, yeah, track record of lobbying and pricing power, if that's the case for that company. Management dilution, strong capital allocation track record. Okay, so you're trying to find reasons, the most common reasons, the major negatives around that company, and then you are answering why they are not going to disrupt your thesis over time. Okay, this is very strong, and it will build your confidence at the time of pulling the trigger. Benefits: protects you from blind optimism and keeps emotions in check. Reinforce with quote, invert, always invert. Charlie Munger. Now, extra emotional guardrails: pre-commit rules, decide in advance, position sizing, target holding period, stop loss rules if applicable. One of the reasons I'm always stressing the importance of understanding what you own and putting a value on a company before committing any capital is exactly because I know how emotions can trick you, right? Once you are once you've made an investment. So, for example, you know that in this depends on position sizing, right? Because if a company at one point makes up 30% or 20% of your portfolio, which can happen if you follow a concentrated approach like I do, you will feel more compelled to sell if you don't understand value. All right. So before putting your money into the company, you should exactly identify what the intrinsic value is. And by the time the stock hits that intrinsic value, you can sell. All right. Or you can take some profits off the table. You will have some maneuver, but the point here is that you know exactly the value of what you are buying, and you are buying with margin of safety, right? So know everything before. No, that's why I say 90% of the work comes prior to making an investment. Once you make the investment, then you just need to check in with the company periodically, and that comes through. So that means tuning into conference calls, right, when they report earnings, reading the quarterly and annual reports. But this all happens periodically, not regularly. So let's go back here once again. System greater than feelings, frameworks and rules protect you fear, greed, hate. We discussed that. Accepting uncertainty. You will never have 100% certainty, but you can control the process, not the outcome. I think, and some people ask me, "Oh, Ed, but what if my investments go down?" Not if, they will, in all likelihood, go down. Okay, and you have to be prepared for that, right? And that, by the way, let me discuss one of Peter Lynch's main quotes. Everyone has the brain power to make money in stocks. Not everyone has the stomach. Okay, you need to be able to stomach that volatility and work it to your advantage. So in my portfolio, you know that some of the positions that I have right now are in the red, and I'm perfectly fine with that. Yeah, I will take those. I will take that any price weakness, any significant price weakness to add more to those companies, provided they are still below the intrinsic value, right? I'm happy to see lower prices, okay, because I understand what I own, and I have confidence in my decision, right? Good. And here are some other quotes. Almost all the great investors that I know are unemotional, and emotionalism is one of the most important criteria for being a successful investor. That's according to Howard Marks, another successful value investor, and Seth Klarman. And successful investors are dominated by emotions. Exactly what we discussed right here. They buy at the top and then they sell at the bottom when they don't have a framework. They don't know what they're doing. Okay, so look, mastering investing psychology is about mastering yourself by embracing the tortoise mindset, journaling, anchoring your goals, and challenging your own ideas through inversion. You protect your portfolio from the biggest risk, yourself, right? Call to work. So this is very important, and I want you guys to stick to a robust framework that will allow you to mitigate all the emotional aspects of investing. Okay, this is not random. There is a process, as you can see, and it comes from understanding market psychology and from making mistakes at the same time. Okay, so all the volatility that you see, that's just noise over the short to medium term. But over time, if you are playing the long term game like we are as tortoises, then you will know that the fundamentals of the business will follow the stock price. And if things in the background are working as expected, we don't care about headlines or news, because that's just noise. Okay, so this is essentially what I wanted you guys to know. Let me know in the comments if you find it useful, and I do hope it helps you make better investment decisions down the line. Last but not least, I want to finalize with this screen here. You can see that Fidelity, and my community members certainly know this because I show this to all of them, that people make the best investors according to Fidelity research. They essentially run a study from 2003 through 2013, and they found out that the best performing accounts were from investors who were there, and the second best performing accounts were from investors who had forgotten they had an account, exactly because they couldn't touch their holdings. In Unlike entrepreneurship, where you have to be active, investors make the most money while being patient, while waiting for that compounding to work its magic. Okay, stick tuned for more, and have a great rest of your day and week.